Right, ladies and gentlemen, and welcome to MacroAce with your host, Tony from FinancialJuice, as well as a head analyst. Hopefully you can hear me clearly and also see the screen nice and clearly. But we have a busy session ahead for us. We've got the Bank of England and the ECB rate decision. So this is how it's going to pan out. I go through the Bank of England prep, do the rates, and then we'll take a little bit of a pause or break, and we'll leave the stream running till we get the ECB rate decision. But for now, don't forget to like and share the video and subscribe to the channel. Share it with your fellow traders. Let's get those views going. Let's get those subscribers going too, and those likes as well. So the Bank of England. So what is it? So it's the Bank of England rate shows the rate that banks pay for interest to commercial banks. Now remember, these banks are parking their money at the central bank in return for a rate of in return for interest. That's usually for the excess reserves that those commercial banks will have. So the higher the rate is, the higher amount that those central banks get for parking their excess reserves at the central bank. But of course, when that happens, commercial banks also raise their interest rates, have to raise interest rates as well for their consumers that go to them. So why is it important? Well, of course, with the way that markets have been reacting to these interest rate decisions from the Federal Reserve that we had yesterday, okay, we've also had the Swiss National Bank rates today, which they went with a 50 basis point hike today. These important bank decisions will, of course, have a wider effect on the will have an effect on the economy, going from the top, the very top of controlling the money flow and how much the economy can grow or slow down. So if you do get high rates, that will tend to lead to a slowdown in growth, or make sure that it doesn't get out of hand. And also that's to do with inflation too, making sure that consumers are kind of put on the back foot a little bit from borrowing money to go out and spend on goods and services. And that also goes for businesses too, and making sure that they don't go splash out with a lot of cash to go buy goods and services. Of course, that leads to higher inflation. Then, of course, you have the flip side, where you have low rates, which is to support the economy and create growth, or to boost inflation to where the central bank wants it to be. So that's why it's important. Again, has a big effect on the economy from the very top, with regards to how the economy can perform in the future. Remember, with interest rates, it usually takes about a year for them to take effect on the economy. As said, also affects banks handing out loans, mortgages and credit, etc. to consumers and also businesses too. And then if we're looking at where the economy is at the moment, of course, this is to understand a very good way to kind of gauge what the Bank of England is thinking about the economic performance and what they need to do in the future, or how strongly they need to react or act to try and bring up growth or slow down growth. So currently at the moment, we had the unemployment rate at 3.7%, which was higher than the previous of 3.6%. The employment change data was at 27k versus the prior of minus 52k. And then you had inflation, which we had that reading this week, which was lower at 10.7% compared to the prior of 11.1%. The UK average weekly earnings year on year, of course, wage prices are very important too. Something that was also mentioned by the Federal Reserve yesterday in the press conference with Fed's Powell, that it's well above the 2% inflation target. So we'll see what other comments that the Bank of England come through today with the average earnings or the wage price or potential for wage price spiral, if there is any. Again, so as I said, it was higher at 6.1% compared to the prior. Good afternoon, Dragan. Hopefully doing well compared to the prior of 6%. Then we had Q3 GDP at minus 0.2% compared to the prior of Q2 at 0.2%. GDP year on year was at 2.4% compared to the prior of 4.4%. Then the UK S&P Services PMI final was unchanged at 48.8. Then if we carry on then, so what did the previous Bank of England statement and rate, what had happened at the last meeting on November 3rd. So the central bank went with a 75 basis point hike. The Monetary Policy Committee voted 7-2 to raise the bank rate to 3%. So we'll go through that in a little bit and the breakdown, but you can kind of see it on the text feed there. Good afternoon. Good evening. We've got a person from Singapore. Hello, Tim. Good evening to you. So also the other point being, so as said, we'll kind of go through the breakdown. What they said is that the peak interest rate is likely to be lower than implied by markets. The majority of the MPs or the members of the committee believe that a 75 basis point hike would reduce the risk of future and costly tightening. They see CPI at 2.2% in the fourth quarter of 2024 and spot 8% in the fourth quarter of 2025 if rates stay at 3%. So remember the inflation target is 2%, as is the ECB's as well. So of course they're going to want to try and probably get to that and do a little bit more, maybe slightly lower than 2%, just to kind of have like a fail safe, just in case inflation does skyrocket or jump back up above the 2% goal. But that is what their forecast is for inflation. They also said that the UK is currently in a recession, and that will last until 2023. The recession had begun in the third quarter with an estimated 0.5% drop in GDP. They also say that the UK economy will contract by 1% in 2024 compared to a 0.25% contraction predicted earlier. And the Bank of England forecast on peak market rate of around 5.25%. So let's go through some of the other stuff then and the comments as to what had happened and the breakdown with the 7-2 vote. Now remember, that's a 7-2 vote to raise the rate by 75 basis points. Okay, so 7 voted in favor for a 75 basis point hike. 2 voted had taken a different choice instead. So you had Tenrero and Dingra. That Dingra was looking at a 50, Tenrero at a 25. But this is what the comments were post the last rate decision. So Bailey said that nobody should interpret the 75 basis point as the new rate hike norm, something that we had seen in the US and until yesterday, them going with a 75 basis point hike them going with a 50 basis point hike instead of a 75, breaking that chain of 4 consecutive 75 basis point hikes. So Bailey just reiterated at the meeting that a 75, the probability of that is, you shouldn't interpret that we're going to continue going with 75 basis point hikes. November 16th, you had the bank, comments as well from Bailey adding that the Bank of England would not intervene in the FX markets, just like we had seen with the Japanese, okay, and the Bank of Japan. They had intervened in the FX market to try and shore up the yen because it was weakening a lot because of their constant easing of monetary policy, and trying to make sure that the yen doesn't see any huge volatile movements in the market. Bailey also added that inflation in the UK is a result of a series of supply shocks. Dingra has said, so she said that over-tightening is now a risk. Considering that we're in double-digit inflation still, yes, there is the potential for that in the future of over-tightening, but the key goal is to bring inflation down as soon as you can, or in a way that doesn't disrupt the economy. So that's probably why she went with a 25 basis point hike, a 50 basis point hike rather than a 75. Also, as said, so earlier on, you've got to keep an eye on the key voters, right? So last time you had, as said, Dingra voted for a 50, Tenrero for 25. Tenrero gave her comments and her thoughts, saying in 2024, policy needs to be loosened. In Q4 2022, the UK is likely to be in a recession, mostly due to lower real incomes, and her vote for the 25 basis point rate rise was for risk management. Yes, it's for risk management, but it did cause the pound to sell off from that decision. That was the decision that she had input into that she had put in. So this is one thing to keep an eye on, is those two, Dingra and Tenrero. What do they do? Do they stick with rebelling against what the other members do at the central bank and cause more havoc or increase volatility for the pound? That is a possible scenario. But if it's expected to happen, or if that they could again go with a smaller rate hike decision, could that mean that there might be less volatility if it's expected? That could be a potential scenario. But in the last two scenarios that we've seen, they basically just switched roles in what they wanted to vote for. But it still caused a havoc for the pound. If we carry on then, so Bank of England's man said that inflation is increasingly embedded in UK firms and rates do not have to be as high as the market suggests. Haskell said the concern for me is a possibility that if price increases become embedded, monetary policy will have to be tighter for a longer period of time. Ramsden said that he would consider cutting the bank rate if the economy pans out differently and inflation persists and stops being a concern. Peel said the base case does not involve rates reaching 5.25%. Inflation is expected to fall rapidly in the second half of next year. And then you had December 1st, you had the Bank of England decision-making panel survey where they said that looking ahead, the DMP members expected inflation to be 7.2% 1 year ahead, down from 7.6%. So that's quite important of where they expect inflation to be and what could happen, whether they do, whether they take another step down at the next meeting post this one to a possible 25 basis point hike instead. But again, there's not too much of a difference there for expecting inflation to be at around 7.2% compared to 7.6%. So there's still a lot of work that needs to be done. So again, there's a possibility that they could continue with a 50 basis point hike and kind of see how the economy reacts. So this is the last meeting that we had of the expectations before the last meeting that we had seen. So Dingra was seen as the outlying member who was the most dovish out of everyone else, who from the neutral scale to the hawkish side of the scale. But this is what we're expecting this time around for the upcoming meeting. So both of them are looking at maybe taking. Now, don't take this as that they would want to ease, i.e., would want to cut rates. The way you should take this is that they're less hawkish compared to the other central bank members, and that means that they could, and as they had done in the past two meetings, vote for a smaller rate hike compared to the rate hike that other central bank members are looking to do. So that's a possible scenario, that these two could crop up again and look for a smaller rate hike, or it could just be either one of these members that could cause extra amount of volatility and pain for the pound ahead. That's the risk that's there for the markets. Then if we're looking at investment banks and market views as well, so you had December 8th, traders paired Bank of England wages and see less than 100 basis point hikes and 100 basis points of hikes by February. So November 14th, you had Morgan Stanley seeing 150 basis points of Bank of England interest rate cuts in 2024. And they see the central bank pausing with their hiking of rates in March of next year. And this is the other thing to bear in mind too. So for the upcoming meeting, the expectation is that there could be three of the very hawkish members of the central bank, which would be Mann, Haskell and Ramsden, that could vote in favour of a 75 basis point hike rather than 50, 4 voting for a 50, and then 2, you could get Tenro and Dingra voting for 2. So that split is going to be very important to kind of understand the breakdown in the voting. Now remember, on the FinancialJuice website, it shows that all members are expected to vote for a hike. Okay, this is just showing you the breakdown of how much they want to hike by. The one big surprise, if we do get it, or if it does happen, is that if you have, the one big surprise that you do have is if one of the members from the central bank decides for a no change in the interest rate, and that will definitely cause the pound to move down, because all the other central bankers are in a hawkish or in hawk mode. They want to get rates up as quickly as they can to a level that could sufficiently hold down inflation, but that will cause confusion and panic within the markets. So again, there are possibilities that we've got to think about how the markets could react to each of these different things. Then if we carry on then, so December 13th, you had, for the first time in 2 weeks, that traders bet the peak rate for the Bank of England to be at 4.75%. So again, there's a bit of a depreciation in the expectation for where the central bank is going to finish off with their rate hiking path. So also what we need to, so if we carry on then, if we could look at the next slide. So this is the last rate decision. We've got about 13 minutes left. Okay, so here we go. So if we just kind of mute this here. So this is about 10 seconds before the release that we had seen last time around. So of course, from what you see with the headline, okay, data comes through. That was a hike by 75 basis points there. Now the reason why you see this choppiness within the markets is because of what had happened with the two voters, Tenrera and Dingra. As I said, Tenrera looked for a 25 basis point hike, Dingra for a 50 basis point hike. And this is why you see that. This is why you start to see sterling see that weakness come into the markets, because of how the Bank of England vote was split up in how much they wanted to raise the rates by. So that has always been the risk. We'd seen it with Cunliffe ages ago now. I think back in the, actually, let me see the deviations. That'll give me a clear sense. So yeah, so Cunliffe back on the 70th of March voted for no change. Back when the central bank was starting to raise their rates again after the second meeting that they had, going from 0.25%, 0.5%, and then wanting to leave the rate unchanged at 0.75%. So that, again, the voters are key. Why, and then it's not the information or the understanding as to why they go ahead with that decision, which you don't really get within the statement from the Bank of England. That's usually something that's left later on, as we'd seen with Dingra and Bank of England's Tenrero. So that was the last rate decision you'd seen. As said, pound had weakened off of the back of that there. And also, there was the Bank of England mentioning that the peak interest rate is likely lower than implied by markets. So that's also another risk as well that was presented by the Bank of England. Okay, so we'll just pause that. Just get out of here. All right. So what have I got open on the site so far? We've got the... so what are we expecting today? Okay, so not only did we get the bank rate earning the expected 50 basis point hike to 3.5%, we also get the monetary policy summary and the Bank of England meeting minutes. Now, what I want to show you guys is the deviations for the economic release last time round, of how strongly the markets had reacted to the last rate decision that we had from the Bank of England. I'll bring that up here for you. So here we go. So cable had a big move of 50 or 51 pip move down. After about 10 minutes of trading, it was down by 14.3 pips. So remember, if you're unfamiliar what the deviations are, this basically shows you how the markets react to economic releases and how big or how strong or how weak the movements were. So the first figure here shows you the initial market reaction going to the wake of the candle. I like to capture the whole move of what had happened, or the initial reaction. And then the brackets show you the brackets show you 10 minutes post the release, how the markets or how that currency pair or asset had moved. So if we're looking at historically what has seen the biggest move, actually, it was the GBP JPY, right? It's a pound yen that we'd seen the biggest market reaction in total. Of course, you have the Bank of Japan easing, continuing with the easing monetary policy, not really letting up on that. That was the reason why we had seen a very bigger reaction in the Japanese yen. And historically, it's been shown to have a bigger reaction compared to cable itself. Then if we're looking at other areas too, so you have the GBP New Zealand dollar and Aussie dollar, which had seen some really nice moves as well. GBP New Zealand dollar being the second biggest mover. You can even see here in the past releases as well. Actually, if I just kind of here we go. So yeah, even in the past releases where you might have seen the GBP or GBP/JPY have a significant move, actually the GBP New Zealand dollar had the biggest move in the 22nd or the September Bank of England meeting. So that's a risk that's presented there, is that you're looking at GBP/JPY historically what we've seen and GBP New Zealand dollar as where you could see the potential for bigger moves within the currency space. And if we're looking at the FTSE 100, it was up by 46 ticks, and after about 10 minutes of trading, it was up by 30. And if we're looking at the long-term gilts or the 9-year gilts within the UK, remember that's the price of the bond, not the yield, that was up by 79 ticks. And then after about 10 minutes of trading, it was down by 39 ticks. So there we go. As said, so here we're showing you the sentiment of what had happened before, why the markets would react the way that they had reacted to the rate decision. But as said, it's these central bank policy members making their decision as to how much they want to raise the rate by, or not raise the rate by, not raise the rate at all. That has a big influence on how the markets would move. So here, look, first time one of the members wanted to look for a 25 basis point hike rather than a 75, which surprised the markets. He had a nice big old move there. And then because it kind of happened again, you still had a decent move in the markets, but the markets were becoming a little bit desensitized to these couple of members that were looking at a smaller rate hike. So what is the expectation then? So usually we've got about 6 minutes left to the release, by the way. So what is the expectations? The expectation would be that if the central bank raises interest rates as expected, then you're looking to what the voters are doing. Okay, is there a split in how much they want to raise rates by, or do you have one of the members, either Tenrero or Dingra, that actually looks for a no change in the rate? Okay, that again is surprising. Could that cause the pound to fall off the cliff? The other surprise that could be presented is that if all members vote in favor of a 50 basis point hike, then you probably might not see too much of a market reaction if the rate has already been priced in as expected. Then you're looking at the rate statements and the monetary policy summary as well. Okay, to see any signs of any dovishness of how long the recession could last within the UK. And where they expect inflation to be. But then on the flip side, you could also have the expectation that inflation might be longer than had previously been predicted, and the central bank may need to raise rates by more than 5.25, by more than 5% in the future in 2023, and potentially maybe for even longer. So that's another risk there as well that could be presented, which could provide some upside a momentum to the pound if, like what we've seen with the Federal Reserve yesterday, upgrading their thoughts on where the federal funds rate could be in 2025 and also in 2023 and 4, that could lead to, as it did yesterday, it led to an appreciation in the dollar. So if the Bank of England do a similar thing today, that could lead to an appreciation in the pound as a possible scenario. I hope that's kind of clear for you. We've got 4 minutes left. If you're unfamiliar with the deviations, or if you wanted to, or if you wanted access to this, then what you can do is you can sign up to the MacroAce mailing list, which is completely free, and then receive on a Sunday is when I send one email out for the week ahead, what to expect in the Europe, US, and Asia session, a summary of the weekend news, a button to take you straight to the live stream links rather than having to wait for them to appear on the FinancialJuice website. So you can kind of get yourself set up and ready rather than trying to go in a rush. And also the deviations for those economic releases too, as I said, and that's completely free. So I've put that link in the chat for you there as well. All right, let's get TICKSTRIKE up and running as well. We've got about 3 minutes left. 3 minutes. Okay. It looks like I have all my currencies that I want there. Let's see. All right. Okay. That's basically all set up. Actually, let me get GBP JPY on here. Because that had the biggest move last time, and also let's get we'll keep up with the GP US dollar. Actually, you know what? GBP NZD. Let's go with that. Right, the big three currency pairs that had a reaction, a big decent reaction last time. All right, is everyone all kind of set with that? Shara Irani said, "How did the FTSE react to this?" Yeah, no, I'd shown you before. It had seen movement towards the upside. Initially, I think it said about 40 ticks was what the reaction was last time round. Let me bring up the deviations again for you, just so I don't say anything wrong. Yes, the FTSE had a 46 ticks towards the upside in the last rate decision. After about 10 minutes of trading, it was still up by 30 ticks. Okay, we go. 1 minute to go. 1 minute to go. 50 base point hike is the expectation. All nine members are expected to vote in favor of raising the rate. We'll look at the breakdown of the rate decision itself, and then we'll kind of take on how the markets react to the data. I'm going to bring that in a little bit because it's a bit hidden. There we go. Ten seconds. Hike. There's a 50 base point hike. 50 base point hike as expected. Oh, 2 members vote for the rate to be unchanged. 7 vote for a hike. So 2 members vote for the rate to be unchanged. Okay, that's causing the pound to go down there off of the back of that. Again, 2 members voted for no change in the rate. Let's go through some of the headlines as well. Okay, so Tenra and Dingra of the Bank of England voted for the rate to be at 3%, and saying that 3% is more than sufficient to bring CPI back to target, and no strong case to tighten on risk management grounds. Is those two again. So they voted for no change. I'll be back in a second, guys. Okay, so let's have a look at the kind of what was said here from the central bank in a bit more detail. Okay, just seeing here, UK OIS market shows slight reduction in bets on the peak bank rate, now slightly below 4.5% in August of next year. It was previously at 4.6%. Let's look at how big the market reaction was. So I said last time the biggest reactions came from, or the biggest reaction in the past came from GP New Zealand dollar and GP JPY. Let's have a little measure up of what GP New Zealand dollar is doing. Okay, so that's about 57.5 pips down there. I'll also look to GP USD. It makes sense. We have to look. We can't dismiss it altogether. So GP JPY. Okay, 53.5. Yeah, 53.5 pips there. Yeah, around that. GP CAD. Okay, it's 50, again, 53.5 pips. So the only surprise numbers that come through is that two members, Dingra and Tenrero, voted to keep the rate unchanged. That's what you can see there. So in this hiking path, in this hiking cycle, that's not a good thing. For sentiment, but the majority of the other members looked for that 50 basis point hike. Check there. Yeah. All right. So FinancialJuice, what we're looking at here on the website. So you can see that data came in nice and quickly. With everything with the rate statement as well. All right, so that's all. That was nice and easy, and simple. So with FinancialJuice, if you're unfamiliar with what FinancialJuice is, or with the understanding of it, so it's a live voice and text service. That remember, a live voice and text service is something that's quite high level that investment banks have access to. Why? Because they want to keep an eye on what's going on within the markets. Why are markets reacting the way that they're reacting? Has there been any news for them to potentially capitalize on a trade or manage their risk? That again is why having a live voice and text service is very important to have in your particularly in your day trading, right? Obviously in your day trading, that's very obvious. It's a very obvious need that a lot of traders have, but don't really have access to. So FinancialJuice, what we want to do is provide you with a 7-day free trial of FinancialJuice Pro. Now, first thing you need to do to make sure is what is the reason why I should go with FinancialJuice Pro, right? What's in it for me? So with FinancialJuice Pro, you have live, no delays to the website at all, with the headlines, the voice news or voice stream that we have here, the economic calendar data that we have here as well. there'll be no delays to that. If you have the live version, there are delays. There are also adverts that are also played as well on the delayed version, which you can which you'll be able to remove altogether with signing up for the pro version. Now, before I kind of give you the link to sign up to the pro version or get yourself set up, first thing you need to do is make sure that you have a FinancialJuice account on the website, i.e. you set an account, you've got a username and password, which you have on the website. Then once you've set up an account, if you haven't done that already, go to your email and you have a verification email that will appear. What you need to do is just verify yourself, go back to the FinancialJuice website, and then there'll be a button here that says Go Pro. Once you've clicked on that button and you've paid for the full pro version of FinancialJuice, then go back to the website. It won't show that you have pro straight away. What you need to do is you need to log out and then log back in to the website, and then you will have pro. And you'll know you will have pro if you have this little symbol here with the FinancialJuice logo, and it says pro with that there. Then you will be all set. Now, if you have any sound issues, make sure you don't have any ad blockers or major ad blockers or VPNs running on the website. Make sure you have from your site settings as well that you have sound and notification on allow, not automatic default. Put it on allow if you're having issues with the sound, and then you should be all good. And then, of course, remember, if you want to go with FinancialJuice Pro, take time with it. If you're not used to using a live voice and text service, have a little play around with it, right? You still have the live version of FinancialJuice to kind of listen into. What you said, that's completely free to have a look at, okay? But, take it at your own pace. Jump on when you want to jump on, kind of get going with Pro. So I'll put in the link for the FinancialJuice site. And then all you've got to do is, as I said, set up an account, verify your account. And if you want to go for Pro, then click on Go Pro button there, pay for it, go back, sign out, then log back in, and then you'll all be set. So that's the link there for FinancialJuice for the homepage. That should work for you. So, other than that, we also have a TICKSTRIKE, which you've been seeing that's been going off on here. Whoa, what are you doing, son? Yeah, stay. Okay. We also have we also have TICKSTRIKE. So if you're unfamiliar with what TICKSTRIKE is, so TICKSTRIKE allows you to listen to order flow. And in another way to put it is, how strong is the buying or selling momentum that you can see within the markets. Okay, so TICKSTRIKE, there's different, you can see here, this is what we call the ticker, okay, or you're representing the asset that you're looking at. Okay, so TICKSTRIKE, remember, it covers Forex, covers crypto, futures, stocks, internals as well. Okay, so like your VIX index, and that's what it also covers too. So what are all these numbers and what is this color that I see here? So the minus number shows you that there is selling momentum going on. You can kind of change whatever the color is that you want to change it to. That doesn't matter. What matters is what this number is doing. Okay, and then the plus symbol, with the number shows you that there's buying momentum that's going on. So why is there 2 or why is there going to 3? What does that actually mean? So here on the ticker, you have a little dial, right? Or a little step ladder here that you can. So 1 means that the market one means that the level of sensitivity is high and it will react to, it's the most sensitive to market reactions, okay, to buying or selling momentum. And then if you increase it all the way to level 15, level 15 is the least sensitive to market reactions, i.e. when there's a big movement occurring, only then will TICKSTRIKE pop off for you there. So particularly, as I said, if you're day trading and you want to capitalize on potential moves or manage your risk, then TICKSTRIKE is definitely the way to go. Of course, there are other ways you can use it, however you want to use it. and then do that. But you can kind of chop and change that level of sensitivity and kind of do what you want with it. So that, we also want to provide you with a 7-day free trial as well of TICKSTRIKE. So there in the chat. And then also, we also have, of course, we've got still got a bit of time to the ECB. So that's TICKSTRIKE there. That's a 7-day free trial that you can have a little go with. What we'll do now is we'll kind of take a little bit of a break now at the moment, and then we'll jump back on at around we'll jump back on at around 7:30. So we've got about 15 minutes to wait till we do the ECB rate decision. I'm just going to work on some charting here and get that sorted out for the deviations. But hopefully you've found that useful for your trading, and also if you found the information useful, don't forget to like the video, subscribe to the channel, share it with your fellow traders as well. We're not done yet. We have one more event left, okay, and then we're done with MacroAce for the week. All right, but thank you very much for joining me. Hopefully you enjoyed that, and I will speak to you in about 12 minutes time. Remember, the next rate decision, the ECB rate decision here, is at 8:15 a.m. Eastern time. So we'll be doing like a 45-minute prep. Although there's a lot more to do with the ECB rate decision prep. Okay, speaking in a bit, guys. All right, we are back and ready. Hopefully, as said, you can, if you are just joining me now, we've got the ECB interest rate decision prep to go through now. We're nearly there. Don't worry. Once we get the rate decision out of the way with, then we're all laughing all the way to the bank, hopefully, and then we're all okay. I hope so. But the ECB then. So what do we have for the ECB? So similarly to the Bank of England with what the deposit rate is, it's the interest rate paid by the ECB to banks having deposit. So similar to the Bank of England rate, you have commercial banks parking their excess reserves at the central bank in return for a rate of interest as well. So, of course, the main interest rate that we will be looking at will be the ECB refinancing rate. That's what is referenced the most. But then also the deposit facility, as said, is where banks can place excess reserves and earn an interest rate that is usually 100 basis points or 1% below the margin, the main refinancing rate, which establishes a floor on the interest rate, since no bank will lend money out less than what it can earn at the deposit facility. So again, that is quite an important part of the interest rate decision today. Then, where is the economy at the moment for the ECB? So inflation at 10% versus 10.6. S&P manufacturing PMI was at 47.1, prior 47.3. Services PMI actual at 48.5, the prior of 48.6. Consumer confidence was at minus 23.9 versus the prior of minus 27.6. The economic sentiment at 93.7 versus the prior of 92.5. And the German IFO business climate at 86.3 versus 84.3. And the ZOO economic sentiment at minus 36.7. Excuse me, that should say with the ZOO sentiment at minus 23.3 compared to the prior of minus 36.7. And then we carry on ahead as well. So the German CPI as well, we've had that data recently as well, hovering around that 10% mark. And if we, as the prior, of course, this is the final data. So if we look at the final data, this is what the prelim data was showing. But of course, the prelim data showed the rate came in at 10% for the inflation rate in Germany. And then prior was 10.4 if we look at the prelim. And the HICP 11.3% versus 11.6%. Okay. Then the previous ECB meeting as well. So we had the 75 basis point hike that was taken for the main rate and the deposit rate as well. Also the lending facility, that was also where the 75 basis point hike was taken. And in terms of the PEPP, or the Pandemic Emergency Purchase Program, that had been enacted since 2020. At the beginning of the COVID era, the ECB intends to reinvest principal payments from the maturing securities purchased through the program until at least the end of 2024. Then following on from that, you have that inflation is still far too high and will remain above the target for an extended period of time. The ECB does not intend to set a start date for quantitative tightening during the December discussions. This is going to be important here, right? What is the ECB, when will the ECB discuss a quantitative tightening and the pace as well of quantitative tightening? And how soon will they start it? Will they start it in at the beginning of next year, quantitative tightening of the bonds that they've been holding on their books for quite a while now, or will they kind of delay it to a later date? And that could set off a market reaction where the euro could see a bit of weakness if the forecast comes in as expected, and instead you could take the expectation of the sentiment that the central bank isn't ready to ease off the brakes that soon with their quantitative easing. So that's also another thing to be aware of, is that now the traders are looking at how soon will the central bank decide to tighten monetary policy and by how much. The ECB rate hike was not unanimous, as 3 officials only wanted 50 basis points of hikes. Of course, 75 basis point hikes, quite large for the ECB decision to take, considering what we've seen in the past. So again, quite historic amounts that have been taken there by the central bank. So ECB minutes on 24th of November, they said that the view was widely shared that inflation outlook continued to worsen and a decline in economic activity will not be sufficient to significantly reduce inflation. So even then, what that's saying is that even if the economy falters or declines, then we will still need to do a lot more work to reduce inflation instead. The Governing Council, or the GC, has also said that they should continue normalizing and tightening monetary policy, although it might want to pause if there was an extended and deep recession, something that is a worry for a lot of the central bank members. Of course, as we've seen in the Bank of England with their statement as well, statements in the past talking about the UK being in a recession. The Federal Reserve hasn't really said that much. But actually, in relation to when I say if they talk about the US going into a recession, they've more been talking about a softish or soft landing that could occur within the economy. But there is a possibility, that they could, it's not off the books entirely, but they're not expecting a recession. They're going to try their best, is what the Federal Reserve had said the last time round. But this is something that a lot of central bank members in the ECB are worried about and have presented their thoughts as well. We'll look at the comments that the different ECB members have presented to the financial markets. And then finally, you also had the ECB minutes that said that 75 basis point hike was supported by a very large majority. And then the ECB forecaster survey as well that we had on October 28th, that's also an interesting point as to where they see what they see how the economy is going to play out for them. Growth is seen negative between the third quarter 2023 and Q1 of 2023, with a cumulative decline of 0.7%. 2023 GDP growth seen at 0.1% versus the ECB's forecast of 0.9%. Forecast 2024 seen at 1.6% versus ECB's 1.9%. So the expectation for where GDP has obviously been brought down in the expectation of these rate hikes taking a bigger effect. And if we look at it here, GDP between 2023 and compared to what it was before in the previous forecast, that's a big old move down in the expectation of how strong how well the economy is going to be able to manage a potential recession and how strong that recession could be. And if that does take a bigger hit and we stay in, if we go into a negative territory. They all say that 2027 inflation is seen at 2.2%, unchanged on the previous survey. Again, the central bank's inflation target is to get inflation to 2%, or that's the target, is 2%. And even by 2027, they're not there yet. 2023, they see inflation at 5.8% versus 5.5%, so an increase in the expectation for the rate. That was in their September projection. 2024 seen at 2.4% versus ECB's 2.3%. So ECB member views then, what do they expect? So going from Lagarde saying that we might have to raise interest rates at several meetings, we might need to go beyond normalization. On November 28th, she said that I would not go as far as to say that inflation has peaked. And also added that rates are still in an accommodative range. November 18th, you had ECB's Nagel, the German Bundesbank governor, said that policy rate is still in expansionary territory and must be moved into restrictive territory. A recession is insufficient to get inflation back to target, and we should start quantitative tightening at the beginning of 2023. So what they want to do is to remove the support from the economy as soon as they can, and then continue with their rate hiking path. That's what Nagel wants to happen, and that's what a lot of the hawkish members want to do, is to start quantitative tightening as soon as possible, kind of deal with, okay, we don't have these bonds on our books anymore. Now we can just deal with trying to normalize policy and go into a restrictive territory. December 4th, Nagel saying personally he favors a 50 basis point hike at the meeting today, or the rate decision today. In Lane, November 21st, said that in December they will make another hike, and scale of it should continue to make progress towards the levels needed. That was in an M&I interview. The November 24th, he had Gwendol saying that inflation may have reached or might be very close to a peak. December 2nd also added that we are seeing that inflation is starting to slow down. And then November 3rd, you had that Panetta saying that we have a comparatively limited understanding of the effects of reducing the size of our balance sheet. So TLTRO and APP and PEP, these are very important to understand. This is support being provided to the economy. Okay, that is very important here. So November 30th, you had a source mentioning, or sources mentioning, that the ECB is to pause the asset purchase facility and the PEP, or the Pandemic Emergency Purchase Program reinvestments, from December 21st to January 1st. Okay, so that's something that could happen, that there is a pause in the reinvestments that are occurring into these bonds that are being provided, or these assets that are being bought. December 9th, ECB banks are to repay 447 billion euros of TLTRO funds early. Right, that's important liquidity for those investment banks. So you already had some news from Italian banks that were starting to pay back or repay the amount that they had borrowed from the ECB. Once you start getting central banks paying back them the amount that they've been loaned to the central bank, that means that they're also ready to kind of handle the higher rate environment and the possibility of a loss in consumers or businesses withdrawing or putting their money or parking their money into that commercial bank. So that's also another very important thing to do with the tightening that's going on within the ECB. But if you think about it, the ECB is one entity of many different nations together. So to try and coordinate a way where the different central banks within, or the different banks, central banks within the European Union and the Eurozone in particular, don't go awry to the point where you have a fragmentation. Okay, that's also another point, another important note to make as well. The word fragmentation is going to be quite key to see how well different central banks in different countries will be able to manage the tightening phase from the central bank of the ECB. Will they put in, will they take extra measures to try and make sure that these investment banks or these commercial banks are able to deal with the loss of liquidity or the requirement to repay the TLTRO funds early, or will there be late payments that occur? That's also another scenario and something that could be brought up in the ECB statement that we get today. Then the bets and expectations. So 51 of 60 economists believe the ECB is to raise the deposit rate by 50 basis points at the December 15th meeting. Of course, that means the other rates as well, the main refinancing rate that we're focusing on or looking at today, would also be raised by 50 basis points. And as I said, that was according to a poll. December 8th, you had Danske Bank saying that at next week's meeting that they expect the ECB to deliver 50 basis point rate hike with a hawkish twist. So you get the rate hike as expected, but then you get a more hawkish statement from the ECB that could push the euro towards the upside instead. So that's something that Danske Bank is highlighting as their expectation. November 10th, traders see peak ECB rate below 3% for the first time since the October hike, i.e. that they're not going to hike they're not going to reach a very high rate in order to try and control inflation. And also there is the risk of a recession being quite large and very disruptive to the European economy. So ING. So this is very useful as to kind of, hopefully you can see that image nice and clearly on the screen that I've presented to you here. But ING present their scenarios of what could be mentioned. The kind of things of what they're looking at. So this is their median expectation of what could be mentioned. Okay, so they see that inflation, in regards to inflation, that the unchanged inflation is to stay high, but 2025 outlook sees it at 2%. When we're talking about growth outlook, their base case scenario, again, unchanged, a risk to the downside, particularly in the near term. Again, something that's been mentioned before. Interest rate being, there being a 50 base point hike and being data dependent. The APP reinvestment is to be phased out, and a hint at the start of the first quarter of 2023. So that's what they see as their base case scenario. Now, where the honey is looking at what their expectations are for the high and low end of the scenarios that they've presented. So if we look at let's start off with the hawkish side first, okay? So in regards to inflation, that they're less, that they're more ambiguous or more worried about when inflation could reach its target. So here, medium-term inflation may return to target earlier than previously thought. That could be a dovish comment there, i.e. again, that inflation is coming down much quicker than they thought. They don't need to do that much work to kind of continue to bring it down. Another comment in regards to growth outlook, that there's a high risk of a sharper, longer-lasting economic slowdown compared to seeing the risks to the downside, particularly in the near term. So there's high risk of a sharper, longer-lasting economic slowdown. Taking the 50 base point hike, but mentioning that there is a worsening outlook, okay, a deterioration in the outlook, and suggesting slow pace of tightening. That again, going from data dependent to it's hit the fan. We've got a worse outlook than we had, or it's about to hit the fan. We've got a worse outlook than we had initially seen. And then the end of APP reinvestments principles discussed, but there's been no decision taken. So no decision as to to kind of throw or get rid of them off of their books and to stop reinvesting. Then, if we're looking at the other scenario presented with a moderately hawkish, or slightly hawkish, if we're looking at dismissing the recent drop in inflation, which should stay high for longer, if growth outlook downside risks to the outlook are slightly abated since October, i.e. they're presenting a scenario where inflation is still not where the central bank wants it to be, or has a potential to kind of get out of hand, hence the need to still be in that restrictive or hawkish or slightly hawkish mode. Also again, if they go for a 75 base point hike and say that they maintain a fully data dependent approach, again, another upside, potential for the upside on the euro within the markets. And finally, the announcement of APPQT start in February 2023 and end reinvestments within that year, rather than saying Q1 of 2023. So, not really giving this gives a clearer outline as to when it could begin. And then the very hawkish side, okay? So your projections show a more prolonged period of above target inflation, risks mostly in the near term. 2024 projections are more upbeat. So what they're saying is, the economy is going to see a depreciation in the economic output, and productivity is going to fall off a bit. But later on in a couple of years' time, the economy is going to be able to handle it and get back up on its feet, and there'll be no issues with it. A 75 base point hike pushing back against speculation on that peak rate is near. So again, the need to continue raising rates and going by a stronger amount is something that is a decision that could be taken. And then also adding that APP QT will start in the first quarter of 2023, and the PEP reinvestments will end in 2023 as well. So there's that on top of that's the difference. So the only difference here is that they include PEP reinvestments are to end in 2023 as well. So I think we can kind of get a little mix here of the different scenarios. You know, you can't just, so with this ING crib sheet, it's nice, it's very useful, but I think you can't really look at one scenario and take that as what's going to happen across the different areas of inflation, growth, rates, or QT. There might be a need, or sometimes I kind of feel that there is a need to kind of mix some of the different bits together to kind of get a base case scenario. So you could see that, you know, instead that they might say medium-term inflation may return to target earlier than previously thought, but there are downside risks to the outlook that are slightly abated since October. Okay, but then you could get maybe a 50 base point hike, but there is still a need to raise rates. So again, there are all these different scenarios that are presented that you can kind of use to amalgamate together into a scenario that fits you and your thoughts on what could occur. So this was the last rate decision that we had then with the ECB. So I'll just make that big. So this is about, well, actually that wasn't too long before the release. So let's kind of go back, go forward. Okay. Okay, so this is about, as I said, about 10 seconds before the release, or the prior release that we had seen. Again, there was a 75 base point hike taken on both the interest rate, or the main refinancing rate, and the deposit rate as well. Okay, so I've played the video, and I'll also get the deviations up and ready as well. So you can see there the 75 base point hike was taken. You can see within the bond market, you see bond prices going up. Okay, on the Bund, the 10-year Bund, the euro had seen a movement towards the downside there. The DAX had seen a bit of movement towards the upside there, off the back of that data. If I just bring up the ECB here and deviations. There we go. So again, 75 base point hike was more or less, it was as expected. And there wasn't really anything surprising or shocking that came out from the rate decision itself. So we didn't get a big of a move compared to what we might have seen in past rate decisions where there has been a surprise. But I'll bring up the deviations here for you to have a look at as well. Okay, so there we go. So again, the euro had weakened and you'd seen everything else strengthen with the DAX and the Bund as well. We'll just kind of exit out of that. Close it for you. Let's go deviations. Let's bring up the last rate. Here we go. That was, so this is something important to note. When there's been a deviation in the interest rate, okay, either higher or lower, in this case it was higher than expected, then you're expecting more of a reaction from the markets. Okay. So when we see the deviation, this is a kind of a reaction that you could expect. So the biggest mover, and still the biggest mover compared to other currency pairs historically has been the euro yen. Okay, when there was a surprise, you'd seen a 71.5 pip move towards the upside here on the euro yen, and then the second biggest mover was the euro New Zealand dollar and the euro Aussie dollar, surprisingly, and then the euro USD as well then moved later. That had as I said, a 50.9 pip move towards the upside. It's not as big as compared to the euro yen or the euro Aussie or New Zealand dollar. Of course, that's mainly because of the difference in the hiking mode and where the dollar is within the markets compared to how valuable the euro is compared to the dollar. And that's why you see, of course, like I mentioned in the ECB, in the Bank of England rate prep, you had the Bank of Japan with their monetary policy easing at that point, continuing to try and boost or shore up the economy. But here we still see historically, actually last time round, the biggest reaction came from these two here, the euro and New Zealand dollar. Of course, not as aggressive as the ECB to a degree with their tightening cycle at some points in the tightening cycle, but there isn't too much of but we had seen that historically the euro New Zealand dollar and Aussie dollar and euro JPY had seen the biggest moves. So 41 pips down on the euro New Zealand dollar and 39.5 pips down on the euro Aussie dollar. And the euro bond, you had 53 ticks up, and after about 10 minutes of trading, that's what the bracket represents. It was up by 90 ticks. So let me just kind of make this clear what the deviations here. What is this chart? So this is showing you how the markets react to releases. Okay, that's all it is. So the first figure here shows you the initial move going to the wick of the candle. I always do that because you want to capture what the entire move was initially, and then after 10 minutes of trading, capture going to the end of the candle after 10 minutes of trading. Of course, a lot of the big chunk of the move would have happened within the first 10 minutes or so, or it could just kind of go on and on forever. Okay, so that is one thing what are we expecting today then? So if we get the data in line as expected, then what you'll be looking for, again with the Bank of England or with any central bank rate decision, is the statement that you get from the central bank. If they provide a more hawkish outlook with inflation or the economic outlook, or maybe they want to start quantitative tightening and PEP QT sooner rather than later in the first quarter of 2023, then that could cause some upward momentum in the euro, noting that they could continue to hike by big amounts of 50 basis points, and they're not ready to slow down that quickly or yet. The flip side of the argument or the scenario is that if the central bank provides, again, same thing, data comes in line with expectation, the central bank says that there is the expectation for a weakening or worsening outlook for GDP and the economy as a whole in the European Union and the Eurozone, and then also providing points that they might want to talk, or they might hint about the fact that they might talk about quantitative tightening at the meeting, rather than actually cementing a timeline for when they will actually do it. So that could lead to the euro seeing a weakness instead. Now, the very obvious points are that if you do get something higher than expected with the figures, or lower than expected, you're expecting more volatility or similar amount of volatility as we'd seen here in this scenario back on July 21st, okay, when they surprised the markets with the amount that they had taken, or with the rates that they had taken, going by 50 rather than taking bigger steps. So if we do get a higher than expected rate, then you'd expect that, of course, the euro to see a lot more pressure or movement towards the upside, or a bit more movement towards the upside. And then if you see a depreciate, or if we see a lower than expected rate hike, let's say if they do a 25 basis point hike, then that would lead to the euro seeing a movement towards the downside. But that's something that's not presented in the scenario with ING, or something that's not been mentioned by other ECB members. So that's going to be quite interesting to see what kind of path that they take. You know, if they do stick with the 50 or go with the 75, or maybe surprise the markets and do, hey, we're doing 25 basis point hikes for each of the rates. And then that will cause, either way, higher or lower than expected, will cause havoc and more volatility is what we'd expect, and bigger moves than if you had just the rate coming in as expected. And then it's just a rate statement kind of peeling the onion to get into the core of what's actually been said, and what, you know, if there's anything new or old that's been mentioned. Okay, so we've got about 11 minutes left. We've got plenty of time. So if you are joining me again here or if you're joining me from the previous video that I did for the Bank of England, if you found that useful, then good. Definitely don't forget to like the video, subscribe to the channel, share the video as well with your fellow traders and friends. I'll be going through the comments as to what has been said and why the markets are moving in a certain way. So I'll try and give you a quick insight or a wrap up of why the markets have moved in a certain way that they have. Whew. All right, I will be back in about 10 minutes or so, or in about 10 minutes, or less than 10 minutes actually. I'll be there at the 1 minute mark. Also, don't forget FinancialJuice. We have the, if you're trading the release live, don't forget to sign up to FinancialJuice, get an account on there. If you don't already have an account, it's very useful to have the live voice and text feed, especially if you're a day trader, right? You're always scalping the markets. Then having a live voice and text service provided to you is very useful because you'll understand why the markets are moving in a certain way, or maybe there's an economic release or headlines come out that's caused the markets to move, and you've seen that on the website and translated it to what the markets are doing. And maybe Lagarde later on might say something crazy. So she might say something about quantitative tightening, maybe, or maybe, you know what, they could even, start talking about it. They could, out of the blue, start it today. They could, I don't think that's going to happen. They won't start it today. Not on Christmas, but no Christmas. Give those banks a bit of time, huh? All right. New email. That's a very interesting username. Says euro going to go down, I guess. Well, we'll see. Let's just kind of, it might be, like I said, you might get the rate as expected, but then if the rate is as expected, you don't have any deviation, then it's just looking through the rate statement itself to get a nice, clearer picture. All right, be back in a second, guys. All right, we've got less than 2 minutes to go. I am back on already. Somebody say Euro New Zealand dollar? Yeah, sure. I'll show that. Yes, of course. Euro NZD. There we go. There we are. Euro New Zealand dollar. Well, let's get the Euro AUD up somewhere. Might be a bit hard to do that here. I'll just do it in here. Euro AUD. Right, hopefully everyone can still hear me, alright? Okay. Alright, there we go. We've got 1 minute to go now. So I might just switch this to the Euro JPY. Okay, these are the three biggest moves last time, so we'll keep that up on here. So Euro JPY, the Euro AUD, and Euro New Zealand dollar. Okay, are we ready? Are we ready, kids? I think it's a good impression. Right. Ten seconds. Hike. There's a 50 basis point hike to 2.5% in line with the forecast of 50 basis point hike. All right, so let's go through this here. So Euro moving towards the upside. Not too much movement there, really. So let's go through the statement as well then. So beginning of March 2023 onwards, the APP portfolio will decline at a measured and predictable pace as the Euro system will not reinvest all of the principal payments from maturing securities. Expected to raise rates further. Not talking about peeling off of the rate. What else? There's nothing really important here. Now see the economy growing by 3.4% in 2022 and 0.5% in 2023, 1.9% in 2024, and 1.8% in 2025. So the February meeting, they will announce the detailed parameters for reducing the APP holdings. So that's what's causing that bit of it wasn't a drastic move really, but a bit of a positive move towards the upside. So giving a date as to when they'll start giving you a date as to when they'll start going through the expectations for APP in the future. If we're talking about inflation. Also they expect, so important bit here, Governing Council decided to raise interest rates today and expects to raise them significantly further because inflation remains far too high and is projected to stay above the target for too long. Again, that's also another point there for a positive move towards the upside on the euro. So they see inflation then projected average of 3.4% in 2024 and 2.3% in 2025. Slightly higher than their previous projection at 2.2% in 2025. Not really much of a difference, to be honest. But it is you can say that's higher. What else do we have? Food price inflation and underlying price pressures across the economy have strengthened and will persist for some time. Let's see what they talk about the economy. Anything else? The euro area economy may contract in the current quarter, next quarter, owing to energy crisis, high uncertainty, weakening global economic activity, and tighter financing conditions as well. Yeah, not really talking about 2024 onwards, how the economy is going to react. So, again, talking about near-term expectation for a depreciation in the Eurozone. Here we go. So, beyond the near term, growth is projected to recover as the current headwinds fade. So that's also another important point too. They see the economy kind of coming back onto its foot. If you remember from the ING crib sheet that they provided. Other than that, to be honest, that's it. So the surprise being that they will give a detailed, point about APP and how they see the economy faring better in the future. But then also expecting inflation to still be higher, and that there is a need to continue to tighten further. Now, if we look at the market reactions, then, so if we look at the Euro New Zealand dollar, that doesn't look like there's a lot of movement that's happening there. But let's measure it anyways. Let's get it in. So that's small. That is 21 pip move towards the upside. Look at the Euro AUD. See what we had here. What we got? Yeah, this is small. Oops. Yeah, it was 14.5 pip move towards the upside. Euro Japanese yen. It's more or less. There's positive news there for the currency, but nothing, crazy out of the blue. Is by how the market's reacting is what I'm taking. Is what I'm taking from here. So, on that initial reaction, about 14 pips up. Let's look at some of the other currency pairs then. Euro GBP. Let's see. Yeah, not that much. Okay, look at that. That's 9 pips. There towards the upside. Let's get Euro dollar. Again, doesn't seem to be that much of the initial movement. So again, it just looks to be, looking at what the statement is saying, as providing a positive sentiment for the euro, but it wasn't, of course, enough on the initial reaction to kind of see it skyrocketing in the air. So that's again, that's a 9 pip move there towards the upside there. All right, I'm going to see what European futures did. All right, I actually saw a nicer, bigger move. Maybe. Or bigger reaction. 53 ticks down. If we look at it in the past, what do we get? That's more or less the same as the reaction that we had last time around. Last time we had 53 ticks up. This time is 54 down on the Eurobonds. Okay, let's see what the stocks. compare 6 ticks down. Let's look at the DAX. Yeah. Okay, 43 down. So last time round, there was 40 ticks was the upside on the DAX. This time around, there's 43 towards the downside, and the stocks 50 really not that much of difference. Last time around, we had 7 ticks up, so not really that much of a movement happened. So kind of not really a disappointing statement. You did still see some movement happening, or something, but it wasn't as crazy or hectic as we had seen in the past. So again, ugh. It's kind of how I take it. Well, let's just see what, in the press conference, what Lagarde says. If she mentions anything further. I don't think she really will doesn't really do it that often when talking about monetary policy or the statement that's been released. But for now, that's really it. That concludes MacroAce for the week. Don't forget, if you wanted access to the deviations for the upcoming economic releases, don't forget we have consumer spending next week for the US. The PC price index is going to be quite key for us. The final data until we go into the till we really go into the Christmas period, and then we're jingling all the way. But yeah, that's it. So if you want access to this data here for the deviations, not only do we have the ECB, but we've got the Bank of Canada, FMC, which we had yesterday too. If you want access to that, that's completely free. I did post it out in the feed, in the comment section for you. I'll put it out again. There we go. So that's completely free. You get a summary of what to expect for the week ahead in the European session, US session, and Asia session. And then you also get those links to the deviations for the upcoming economic releases of the week, the live stream links as well for those upcoming releases. Just what I want to kind of get you guys to understand is that the information about the week ahead of what to expect in different sessions and the summary of the weekend news, it's short, compact. There's not a huge amount that's put into it. It's concise enough, because in the presentation or the live stream that I do with you guys, that's where the honey is. That's why I prefer to explain the details, and that's a better way to do it, on more of an interactive way to do it with you guys here. All right, that is it. Don't forget to like the video, share the video, subscribe to the channel as well. Take care. Have a great weekend. If I don't see you next week, enjoy your Christmas and your New Year as well. Don't eat too many pies. Who ate all the pies? Don't eat too many pies. Try and keep your weight down if you can. But hey, heck, it's Christmas. Do whatever you want. Go crazy. Go nuts. Okay, just a little note here. The ECB August 2023 ESTR forward rises to 2.9% from around 2.8% before the ECB statement. Other than that, thank you very much for joining me, and take care, guys.